You put $100 in the bank today. By next week, that same $100 will exist in at least 3 other places at the same time. Not copied, not stolen, created. And the strange part? Is completely legal. It's been happening for over a century. And almost nobody who uses a bank account actually understands how it works. This isn't a conspiracy theory. It's not some hidden vault scheme or shadow banking myth. It's the actual operating system of modern money, and once you see it, you can't unsee it. So let's start with the uncomfortable question. When you deposit money in a bank, where does it actually go? Most people picture a vault. Rows of cash sitting behind a steel door, waiting for you to come back and get it. That image is comforting. It's also almost entirely wrong. Here's what actually happens. The moment your $100 hits the bank system, the bank doesn't just hold it. It lends most of it out. Not eventually, almost immediately. And the person who borrows that money for a car, a business, a mortgage deposits it into their own bank account. Now here's where it gets strange. That new deposit becomes a fresh $100 sitting in the system. The bank treats it like new money because in every way that matters, it is new money. Can be lent out again, and again, and again. One deposit, multiple loans, multiple accounts, all showing the same money, existing at the same time in different places. This is called fractional reserve banking. And the fraction in that name is doing a lot of quiet work. Banks are only required to hold back a fraction of every deposit. The rest gets loaned out. For most of modern banking history in the United States, that fraction hovered around 10%. Which means, in theory, your original $100 could support up to $900 in new loans across the banking system. 9 times the original amount. From nothing but paperwork and permission. Let that sit for a second because this is the part banks don't put in their commercials. They're not just storing your money. They're using the mere existence of your deposit as license to manufacture new money that didn't exist 5 minutes earlier. And this isn't some obscure loophole buried in financial law. It's the foundation of how economies grow. It's how a small town can suddenly have 12 new homes built in a year. It's how a business with no cash on hand can hire 50 employees before it ever earns $1 in revenue. Money isn't just moving through the system. It's being generated by it. So why does this matter right now? In a way, it might not have mattered 20 years ago. Because the checks on this system have quietly changed. In March of 2020, the Federal Reserve did something that barely made headlines outside financial media. It dropped the reserve requirement for banks to 0%. Not lowered it. Eliminated it. Banks were no longer legally required to hold back any fraction of your deposit before lending it out. The safety rail that had existed in some form for over 100 years was quietly removed, in the middle of a global crisis, while everyone was distracted by something else entirely. Most Americans have no idea this happened. It wasn't debated on cable news. It wasn't a headline anyone screenshotted. It was a technical policy change buried in a press release, and it fundamentally altered how money multiplies through the economy. So let's slow down and rebuild this from the ground up, because the mechanism itself is almost elegant in how simple it is. Step 1. You deposit money into Bank A. Step 2. Bank A doesn't need to hold on to most of it. It lends a large portion of that deposit to someone else for a mortgage, a business loan, a car. Step 3. That borrower doesn't stuff the cash under a mattress. They spend it or they deposit it into Bank B. Step 4. Bank B now treats this as a brand new deposit. Can lend out a portion of that money too. Step 5. Repeat. Across thousands of banks, millions of transactions, every single day. Each step in that chain isn't fraud. It isn't a bank overstepping its authority. It's the system working exactly as designed. The money supply doesn't just represent value that already exists somewhere. It expands based on trust, paperwork, and the assumption that not everyone will ask for their cash back at the same time. That last part is the quiet tension underneath the entire system. Banks are betting that you won't all show up on the same day asking for your money. Because if you did, they wouldn't have it. Not because they're broke. Because the money isn't sitting there waiting. It's out in the world, several loans deep, doing other jobs. This is why, historically, when trust breaks, everything breaks with it. In 1930s America, that trust collapsed. People panicked, ran to their banks, and demanded their money all at once. The banks didn't have it because it had never all been sitting there in the first place. Over 9,000 banks failed in that decade. Not because the money vanished into some scandal. Because the system was never built to survive everyone asking for the truth at the same moment. Now here's the part that should genuinely unsettle you. That same structural vulnerability still exists today. It just moves faster. In March of 2023, Silicon Valley Bank collapsed in roughly 48 hours. Not because of some slow multi-year decline. Depositors got nervous, started pulling their money out through phone apps, and the bank simply didn't have the liquidity to keep up. $60 billion in withdrawal requests came in on a single day. A bank that regulators had called healthy weeks earlier was gone before most customers even finished reading the news alert. This is the uncomfortable math nobody wants to say out loud in plain language. Every bank, at any given moment, holds only a small percentage of what it owes its depositors in actual accessible cash. The rest is loaned out, invested, tied up in bonds, mortgages, business debt. The system runs entirely on the assumption that depositors will keep behaving calmly. The moment that assumption breaks, speed becomes the enemy. What used to take weeks to unfold during a bank run in the 1930s now takes hours, because withdrawal requests move at the speed of a banking app, not a physical line outside a building. So let's contrast the hype with the reality, because there's a very different story that gets told about how banking works. The hype says your money is safe, insured, sitting there for you whenever you need it. The reality is more layered. Yes, deposit insurance exists. In the United States, the FDIC insures deposits up to $250,000 per account. That protection is real, and it prevents the kind of mass panic that defined the 1930s. But insurance isn't the same as your money physically existing in a vault waiting for you. It's a promise backed by a government agency that steps in after a failure to make you whole, usually by absorbing the failed bank into a healthier one or paying out from an insurance fund built from fees the banking industry itself pays in. It's a safety net stretched underneath a system that is, by design, always slightly overextended. This is where things get bigger than any single bank collapse. Because if money can be created this easily through lending, one obvious question follows. Who actually controls how much of it gets created? The answer sits with the Federal Reserve, the central bank of the United States. Through interest rates, reserve policies, and a handful of other tools, the Fed effectively sets the pace at which this entire multiplication process speeds up or slows down. Lower interest rates make borrowing cheaper, which means more loans, which means more new money entering the system. Raise rates, and the opposite happens. Borrowing slows. The multiplication effect cools off. This is why a single sentence from the Federal Reserve Chair can move global markets within minutes. It's not just commentary. It's a signal about how fast new money is about to flow through an already stretched system. Zoom out far enough and you start to see the real shape of the modern economy. It isn't a pile of fixed wealth being divided up and passed around. It's an expanding balloon, inflated continuously through debt, lending, and trust, with central banks deciding how much air to add or release. Every mortgage, every business loan, every car payment, every dollar of national debt, all of it is part of the same expanding structure. And here's the part that deserves real scrutiny, delivered without exaggeration, in only precise terms. Total U.S. household debt crossed $17 trillion in recent years. National debt has passed $34 trillion. None of this exists as a stockpile sitting somewhere. It exists as a web of obligations, each one built on the assumption that borrowers will keep paying, banks will keep lending, and depositors will keep trusting the system enough not to test it all at once. It has worked remarkably for a very long time. Not because the system is flawless. Because enough people, enough of the time, don't ask the uncomfortable question. There's a quiet irony sitting underneath all of this. The safest feeling financial habit most people have, putting money in the bank, is also the exact mechanism that keeps this entire multiplying structure running. Every deposit isn't just protection for you. It's fuel for a system that immediately puts that same money back to work, several times over, often before you've even left the building. You're not just a customer in this system. You're an unpaid, unaware participant in how new money gets manufactured. None of this means the system is a scam, or that your money isn't real, or that banks are secretly malicious. Most of the people working inside this system are simply operating within rules built up over more than 100 years. Rules that mostly work most of the time for most people. But mostly working is not the same as fully understood. And that gap between how confidently people talk about money and how little most of them understand about where it actually comes from is where real financial risk quietly lives. So here's the question worth sitting with long after this video ends. If money can be created this easily, through nothing more than lending and trust, what does that say about what money actually is in the first place? Not what it represents, not what it buys, what it fundamentally, structurally is. Because if the answer is simply confidence, dressed up as currency, then the real asset every bank, every government, and every economy is quietly protecting isn't the money itself. It's your belief in it. And belief, unlike money, cannot be printed on demand.